The worst day on Wall Street since the crash of 1987.
The Dow traders are standing there watching in amazement, and I don't blame them.
We're now down 43%.
Almost everything there completely wiped out. And the NASDAQ, everything and more has been completely wiped out.
Let's talk about the speed with which we are watching this market deteriorate.
The 2008 financial collapse was more than just a story of Wall Street greed and a housing market bubble bursting. It was a perfect storm, fueled by a web of risky decisions, ignored warnings, and behind-the-scenes deals that many have never heard about.
I think this is the most significant financial crisis in the post-war period.
There are fears the sell-off will continue on Wall Street.
Soaring gas prices, falling home prices, and rising unemployment.
While the headlines focused on the big players like Lehman Brothers and AIG, there were layers to this crisis that were hidden from the public eye, pieces of the puzzle that only insiders could piece together. Let's start with the backroom conversations between regulators and the big banks. While publicly, everything seems under control, some of the most powerful people in finance were frantically working behind the scenes to keep the system from collapsing.
Fannie Mae and Freddie Mac are so large and so interwoven in our financial system that a failure of either of them would cause great turmoil in the financial markets.
The seizure.
A few insiders knew as early as 2006 that the housing market was on shaky ground. Hedge funds and major financial institutions were betting against the market even as they reassured investors and the public that everything was fine. It was a dangerous game of chicken, with everyone hoping they could get out before the inevitable crash. One of the lesser-known aspects of the collapse involves the credit rating agencies. These agencies, responsible for assessing the risk of mortgage-backed securities, were operating under intense pressure from the banks that were paying them.
Funds, municipalities, insurance companies, and university endowments have relied on credit ratings to protect them from Wall Street excesses and distinguish between safe and risky investments.
What's often overlooked is how some ratings analysts raised red flags early on, but were silenced or ignored. These agencies continued to give top ratings to toxic assets, knowing full well they were anything but safe. Another hidden factor was the role of shadow banking, a term that covers the unregulated financial activities that were happening outside the traditional banking system. These activities included complex derivatives and off-balance sheet entities that obscured the true extent of the risk. When the market finally crashed, these shadowy operations magnified the impact, turning what could have been a contained event into a global catastrophe. This is the untold story of the 2008 financial collapse, not just of an economic failure, but the high-stakes gamble that left the world reeling. The 2008 financial collapse wasn't just a fluke or an accident. It was the result of decisions made by a handful of powerful people who were more interested in profit than in the health of the global economy. These decisions, often made behind closed doors, set the stage for one of the most devastating financial disasters in modern history: the executives and traders. Let's start with the top executives of major financial institutions who pushed their companies toward the edge. Richard Fuld, the CEO of Lehman Brothers, is often seen as one of the villains of the story. Under his leadership, Lehman Brothers aggressively invested in subprime mortgage-backed securities, even as the housing market started showing cracks.
Lehman don't have deposits. What they do is borrow money from other banks, and that money runs faster than any depositor can run.
So subprime mortgages begin to default. Lots of people are invested in those mortgages. Banks have a big stake. And so suddenly when banks look vulnerable, then they don't lend to each other anymore. Investors pull back.
Fuld knew the risks, but was driven by the potential for short-term gains. He kept doubling down, refusing to sell off these toxic assets, thinking the market would somehow turn around. But it didn't. Meanwhile, over at Goldman Sachs, traders like Fabrice Touré were doing something even more cynical. They were not just selling risky mortgage-backed securities to their clients, they were betting against them at the same time.
Wall Street bank Goldman Sachs will pay $5 billion to settle claims that it duped clients with rotten mortgage investments that Goldman knew were likely to fail. This was part of the widespread mortgage fraud that triggered the Great Recession in 2008. Goldman is the last of the big banks to settle with the government, and Dean Reynolds has more on this.
This practice, known as shorting, meant they were profiting from the very collapse they helped engineer. Toure even joked about it in emails, calling himself Fabulous Fab as he sold these doomed investments to unsuspecting buyers. The rating agencies, a key player in the crisis, often overlooked, was the credit rating agencies, Moody's, Standard & Poor's, and Fitch. These agencies were supposed to be the gatekeepers, ensuring that financial products were safe for investors. But there was a dirty little secret. These agencies were being paid by the very banks whose products they were rating. This created a massive conflict of interest. Internal documents and testimonies have revealed that some analysts within these agencies knew the products were risky, but were pressured to keep issuing high ratings. The regulators and politicians. Behind the scenes, the regulators who were supposed to keep the financial system in check were either asleep at the wheel or complicit. Alan Greenspan, the then chairman of the Federal Reserve, was a huge proponent of deregulation. He believed that the market could self-regulate and that government intervention was unnecessary. This hands-off approach allowed the housing bubble to grow unchecked, fueled by risky lending practices and complex financial products that few truly understood. Timothy Geithner, who was the president of the New York Federal Reserve, played a critical role as well. While he was deeply involved in the efforts to save the financial system, once the crisis hit, some argue that his close relationships with Wall Street executives influenced his decisions.
When credit financed in very dangerous ways with a system vulnerable to run. But it was terrible mostly because we didn't have enough degrees of freedom to contain the damage to the economy, to protect people from the effects, and that was because
there's evidence that Geithner and others prioritized bailing out banks over protecting ordinary homeowners who were losing their homes at an alarming rate, the hedge fund managers. Then there were people like John Paulson, who saw the crisis coming and decided to cash in on it. Paulson made billions by betting against the housing market, specifically by shorting the very mortgage-backed securities that others were buying up. He worked closely with banks to create these toxic products, fully aware that they would fail. While it's easy to admire his foresight,
did you have any doubt that that trade was going to work?
Well, we were pretty convinced that the mortgage market, segments of the mortgage market were overvalued and were likely to implode. So we took
These are the people and decisions that fueled the 2008 financial collapse. Issues arised. The 2008 financial collapse wasn't just a one-time disaster. It set off a chain reaction of issues that still affect us today. One of the most significant consequences was the erosion of trust in financial institutions. Before the collapse, banks and investment firms were seen as pillars of stability. But when the dust settled, it became clear that many of these institutions had been playing fast and loose with people's money. This led to a crisis of confidence, where everyday people began to question whether their money was safe anywhere. Another issue that emerged was the massive increase in government intervention in the economy. In the aftermath, governments around the world had to step in to bail out failing banks and stabilize the economy. The Troubled Asset Relief Program in the US is a prime example. While it helped prevent a complete financial meltdown, it also sparked widespread anger. Many people felt that the government was using taxpayer money to save the very institutions that had caused the crisis in the first place, while ordinary people were left to deal with the fallout, like losing their homes. Michael Burry reveals the pivotal moment when he recognized the unsustainable nature of the housing market. He explains how he saw the subprime mortgage crisis unfolding before many others did. His analysis led him to bet against the housing market, a move that would eventually make him a key figure in the story of the 2008 financial collapse. Burry's insights were based on detailed research and a deep understanding of mortgage-backed securities. He realized that the financial products tied to these subprime mortgages were highly overvalued and vulnerable to a market downturn. Despite skepticism from others in the financial community, Burry's decision to short the housing market showcased his ability to anticipate and act on emerging risks that most investors were either ignoring or underestimating. This foresight not only made Burry's hedge fund, Scion Capital, highly profitable, but also highlighted the broader systemic issues within the financial system. His successful bet against the housing market was a critical part of the narrative that exposed the flaws in the financial system and the disastrous effects of unchecked risk-taking. In short, the 2008 financial collapse didn't just disrupt the economy. It fundamentally changed how people view the financial system, the government's role in the economy, and even their own futures.